So let's have a real honest conversation today. No fluff, no sugarcoating, and no generic real estate hype. I want to talk to you directly on a very specific group of people right now here in the Fraser Valley. If you're watching this, there is a good chance you are what I call an accidental landlord. But maybe you bought a pre-sale townhouse in Willoughby 4 years ago, thinking it would be a brilliant investment. Maybe you kept your old condo in Surrey Centre where you upsized, thinking the rental income would easily cover the mortgage. Or maybe you bought an investment property at the peak of the market because everyone told you that real estate only goes up. But today, right now in 2026, the reality looks very different. Your mortgage renewal came up and those rates hit you like a freight train. Your strata fees have skyrocketed because of new insurance premiums. Your property taxes went up again, and suddenly that property that was supposed to build generational wealth is bleeding cash every single month. You are feeding it 500 or maybe $1,000 or more out of your own pocket just to keep it afloat. You're stressed, you're losing sleep, and you're wondering how much longer can I keep doing this? I'm Amman Rawji, and I help buyers, sellers, and investors navigate the real estate market in Langley, the Fraser Valley, and Greater Vancouver. And today, I'm going to give you the exact rescue plan you need if your investment property is underwater. First off, take a deep breath. You need to hear this, and you need to internalize it. It is not your fault. You did not make a foolish decision. You made a decision based on the information, the interest rates, and the market conditions that existed at that time. Nobody has a crystal ball. The macroeconomic environment shifted drastically, and you got caught in the crossfire. There is zero shame in that. I work with incredibly smart, successful people every single day who are in the same exact boat. The absolute worst thing you can do right now is to let pride or panic freeze you into doing nothing. We need to treat this like a business, remove the emotion, and look at the cold hard math, because right now you have 3 distinct options. And we need to figure out which one is going to save your financial future. Option number 1 is what I call the hold and optimize strategy. Now, this is for you if you have the cash reserves to weather the storm, but you just want to stop the bleeding. The first question we ask is, have you actually maximized the revenue on this property? If you have had the same tenant in there for 3 years and you've been afraid to raise the rent because they are nice people, you're subsidizing their life with your savings. We need to take a look at the maximum allowable legal rent increases. Next, we look at the debt. Have you spoken to a mortgage broker? And no, not just your bank, but a specialized broker about re-amortizing your loan. If you can stretch the amortization back out to 25 or even 30 years, yes, you pay more interest over the long haul, but it might drop your monthly payment by $600 or $700 right now. That could be the difference between bleeding cash and breaking even. We also need to look at your tax strategy. Are you properly writing off every single eligible expense? The strata fees, the property maintenance, the property management, the interest portion of your mortgage. Sometimes a negative cash flow properly can actually save you a significant amount on your personal income tax if structured correctly with your accountant. But let's be very clear. Option 1 only works if you genuinely believe the property will appreciate enough over the next 5 years to justify the monthly losses. If it's a rapidly aging wood frame condo with a massive special levy looming, holding on might just be financial suicide. That brings us to option number 2, the strategic loss exit. This is the hardest pill to swallow for most people, but sometimes It is the absolute smartest move you can make. A strategic exit means selling the property even if it means you are taking a loss on paper compared to what you paid for it. I know that hurts to hear. Human beings are hardwired to hate losing. It is a psychological concept called loss aversion. We would rather hold on to a losing asset for years, suffering every month just to avoid admitting we took a hit. But I want you to think about the opportunity cost. Let's say you're losing $800 a month on this condo. Over 2 years, that is almost $20,000 of your hard-earned after-tax money just gone. Poof. Hand it over to the bank. What if instead you just sold the property? Yes, maybe you walk away with less equity than you had hoped. Maybe you just break even and clear the mortgage, but you instantly stop the monthly bleeding. You take your life back, you take your sleep back, and whatever capital you do pull out, you can redeploy it into a much better, safer asset. Maybe you put it into a high yield index fund. Maybe you use it to upgrade your primary residence, which by the way is completely tax-free when you eventually sell it. Selling at a loss isn't a failure if it stops the bleeding and allows you to pivot. It is a strategic business decision. I have helped numerous clients run this exact math. When we map out what holding for 3 or 4 or more years actually costs them versus taking a slight hit today, they almost always choose the peace of mind. They sell, they breathe a sigh of relief, and they move on with their lives. Finally, we have option number 3, the creative pivot. This requires some flexibility, but it can be a lifesaver. Let's say you own a detached home as your primary residence, and you own an investment townhome that is bleeding cash. Have you considered moving into the townhome yourself and renting out your larger detached home? Detached homes in the Fraser Valley command massive rental premiums, especially from larger families or multi-generational households. By swapping where you live, you might turn a severely negative cash flow situation into a positive one overnight. Another creative pivot is exploring short-term or mid-term rentals if your strata and local bylaws allow for it. Furnished rentals for corporate clients, traveling nurses, families displaced by insurance claims can generate 30 to 55% more revenue than a standard unfurnished year-to-year lease. It requires more work, absolutely, but it might be the bridge you need to get through this high interest rate environment. So where do you go from here? You need to stop guessing. You need to stop losing sleep. You cannot make a 6-figure financial decision based on panic or hope. You need hard numbers. Here's what I'm offering you today. If you're sitting on an investment property in Langley, Surrey, or anywhere in the Fraser Valley or Greater Vancouver, and it is bleeding cash, I want you to reach out to me. My contact info is down below in the description. Send me a message that just says portfolio. We will get you on a completely private, zero pressure phone call. You tell me what you own, what your mortgage payment is, and what your strata fees are. I'll run a hyper-local comparative market analysis. I will tell you exactly what the property is worth today, exactly what you could legally rent it for, and we will map out the math for all 3 options. We will look at what it costs to hold it. We will look at what you walk away with if you sell it, and we will see if there are any creative pivots available to you. You don't have to navigate this alone. The market shifted on you, but you still have options. The only wrong choice right now is doing nothing while your bank account drains. Reach out to me today. Let's get your rescue plan in place. Thank you so much for watching. If this video brought you some clarity, please hit that like button so it can reach many other homeowners who might be struggling right now with a very similar situation. And also subscribe to my channel for my weekly videos and honest local real estate advice. And I'll see you in the next video.